I'm Josh Rubin.
I'm Mark Chin.
This is the Rubin Special.
And here's what you need to know this week.
This week, the first quarter numbers are in, and we're seeing significant year-over-year gains.
We show 3 ways buyers can sweeten their bids in this hot market.
We've seen mortgage rates increase the most since 1994.
We talk about how the Miami building collapse affects national lending policy.
We're just seeing the first quarter numbers come in, and they did not disappoint.
Year over year, median prices were up 10.7%, Josh, and that was unexpected in light of the huge year we had last year.
That's right. We were up year over year significantly, and we built on that with average prices up nearly 20%. The average apartment in Manhattan is now $2 million. That's up over last year's $1.7 million. And of course, activity continues through the first quarter into the early second quarter, and we're seeing no sign of abating.
Absolutely. And when you see the average prices up so much more than the median prices, it just goes to show that the luxury market is extremely healthy here. The number of sales in total is up over 45% from first quarter of this year to first quarter of a year ago.
Right. We saw 3,585 total sales in the first quarter. Again, we're seeing activity continue even in the face of recent increasing mortgage rates. Recently, we've seen mortgage rates rise more than 1.5 points just since the beginning of the year. That's the fastest acceleration since 1994 and some of the highest rates we've seen in the last 3 years.
August of last year, we saw 2.67%, so at 4.8, fundamentally changing how this market is behaving. Refis, for example, are down 60% in the face of this rate rise.
And we're seeing the euphoric housing market start to cool just a little bit, but a lot of home buyers are getting out there making stronger offers to put off paying even higher interest rates, which are forecast for later this year.
Of course, higher rates impact affordability. So many first-time buyers are being squeezed. However, at the higher end, many buyers are all cash, and it has less of an effect on them.
Last year's tragic collapse of the Champlain Towers in Miami's Surfside neighborhood has served as a catalyst for Fannie and Freddie to now be taking a closer look at underwriting certain loans and co-ops and condos across the country.
That's right. So for those buildings that have structural defects that are not being addressed, lenders are being very, very cautious, in fact, not lending to any unit in that building.
And we're seeing that show up here in the Manhattan market, believe it or not, with buildings that were built 30 and 40 years ago, now showing some signs of wear. They're having to put plans in place to shore up those structural defects. With one building in particular, we recently had a listing now being on multiple lenders' declination lists. So if you're in a co-op or condo that's built more than 10 or 20 years ago, be sure to be proactive about any structural issues that might come up.
Due diligence on these issues has never been more important.
In today's competitive landscape, buyers are looking for ways that they can set themselves apart from the pack to win their bid. One of those ways is to make an offer which is not contingent upon their ability to get financing. What do we see in that, Mark?
Well, what that means is if the buyer is unable to obtain financing on their terms, they are committing to close even if they don't get financing on the terms they expect.
Now, Mark, is that the same thing as a cash offer?
To the seller, it is nearly the same thing. Either way, the buyer is going to close with or without financing. Another thing that we're seeing buyers having success with is waiving inspections. You want to tell us why that matters, Josh?
Well, typically when you buy a house, it's contingent upon a clean inspection. So you have the right to sign a contract with the seller, and then you'll go with an inspector and you'll find things like potentially a leaky roof or a boiler that's at the end of its life expectancy. And buyers will typically go back to the seller and say, hey, that $1.2 million that I was going to give you for your house, well, in fact, it needs a new roof and a new boiler, so I want $100,000 off of the asking price. So buyers are going in with greater confidence and saying, I'm willing to take the risk and not come back to you if it needs these things. So they're often waiving any inspection contingencies.
That's right, Josh. If I had 2 bids as a seller, and one of them had an inspection contingency and one did not, clearly the one without that would be more attractive. Often sellers really have to sell their home that they're in order to have a down payment for the next purchase. So allowing for the seller to have a post-closing occupancy often is very, very attractive to sellers.
That's right. What we often see is significant escrows or money that's held back from the closing in order to encourage the seller to actually move out on schedule. So they can have the funds available to put down as a down payment on a new purchase and subsequently close on their new home.